Thank you for joining me on this video. My name is Rodney Constable. I am the president of Simple Market Signals at simplemarketsignals.com. Today we are going to be doing technical analysis on the S&P 500 for Tuesday, February 25th, 2020. And we're going to be using my stockcharts.com charting service, which I am a paid member. And I will leave a link to their service in the description box below this video. What we're looking at here on this first chart is a 5-day, 5-minute chart. So each candlestick represents 5 minutes of trading in the S&P 500. And in the right-hand side of the screen here, and unfortunately in the lower right, you can see where we finished today. We finished at 3118.77 on the S&P 500, down another 3.03% today. So this has been a pretty bad 4 days actually in the markets. Last Wednesday was pretty good. We closed above 3380 for the only time in history and set a new all-time high on the S&P, but we couldn't hold that on Thursday. You can see here on Thursday, the 20th, where my cursor is, you can see that we opened above 3380. It was looking pretty good there, but broke beneath that about 11 o'clock, sold off for about a half an hour. We were able to climb back up and close above 3370. So as of Thursday's close, it was looking pretty promising because that 3370 level had been acting as a short-term support level for about a week, week and a half. But on Friday, we gapped down and then closed towards the low of the session. And then, of course, over the weekend, there was more news about the spread of the coronavirus and, unfortunately, more deaths. And so the combination of that plus other things going on, plus the fact that we just had an old, tired run there, in my opinion. But so it's a combination of things, right? It's never any one thing, guys. It's always a combination of things. The global economy and the markets are so complex that it's never just one thing. But the combination of all this, we've obviously sold off quite a bit over the last couple of days, broke beneath some key support levels that I was looking at. And so what we're going to do here is we're going to pull back, and now we're looking at an hourly chart. So each vertical bar, each candlestick is an hour of trading in the S&P 500, and the time span here is 2 months. And you can see here that I've annotated the some of these support levels we've been talking about. 3370 that had been there for about a week, week and a half. We closed above this 3380 for level for 1 day, as we just looked at. And then once we broke this 3330 level, which had been acting as right here back in January, it was acting as overhead resistance, and then it acted as support. Once we were able to get back above that, this right here, this break is when the coronavirus news first came out, and then we were able to quickly recover, get back above this 3320, 3330 level, make a new high. Unfortunately, as we now know, it didn't hold, and you can see here that in the last 4 trading sessions, man, we have just dropped like a rock. And unfortunately, we have now broken beneath this 3220 level, which had been the most important support level, in my opinion, that we had in place because it had been where we had been trading since December 20th. And we hadn't had any closes beneath 3220 since December 20th. And now that we've broken beneath that, that's not good in the short term. So let's pull back here. And now what we're looking at is a daily chart where each candlestick represents 1 day of trading in the S&P 500, and our time span on this chart is it's a 1-year chart. And so what we can see here, again, this is that 3220 level, and you can see this is what I was talking about, that on December 20th, this huge vertical spike of volume that we had pushed us above this 3220 level where we had closed every day. We came back and tested it when the news first came out about the coronavirus, but we had not had one single close up until today since December 20th that was below 3220. So now that we've broken beneath this, we've come down to this next support level, this 3100 to 3120 level. As you can see, there's a little bit of support there. Is it going to be enough to hold up? Who knows, guys? I mean, with as fast as this market has sold off, you would almost expect in the next day or two some kind of a slight rebound, but there's no guarantee in that, okay? So this is a dangerous market. Simple Market Signals subscribers were warned yesterday that the signal had changed, and I sent out another notice to my subscribers today letting them know that the early bird indicator had went negative. So if you want to find out more about all of that, watch my video introducing Simple Market Signals, which I will have in the description box below this video, because my subscribers have been warned for the last couple of weeks that one of the key indicators within my model was peaking where it normally, tops before it starts to roll over. So Simple Market Signal subscribers for the last couple of weeks had been forewarned that something like this could happen. And by the way, guys, a subscription to my service is less than $20 a month. Okay, so there's no excuses if you want it, if you want to benefit from it. The cost is not the issue. I probably priced it too low for my own good, but I wanted to make it affordable for everybody. So it's less than $20 per month. Okay, with that said, again, this 3120 level, there is some support there. Again, 3100, and any of you that have been watching my videos over the last week or so know that I've been talking about the distance that we have been trading above the 200-day moving average. Up here, we had been as far as 11.5% above the 200. It's not completely unheard of, but that's a pretty good spread. And oftentimes what I found in my research is that when you're trading that far above the 200-day moving average, the situation oftentimes resolves itself with a move back to the 200. So it looks to me like that's probably where we're heading, unless some piece of good news comes out in the next couple of days to turn this around. But there doesn't seem to be any place to hide. Everything's been selling off. And I'll show you a little bit more about that here in a second. And by the way, I produced another video this morning called The Fallacy of Diversification, which I would highly suggest you go out and watch. It's super educational, and I went into how the global markets are highly correlated these days. So another great video, and again, I just released it this morning. Okay, so this gold line is the 200-day moving average. We've got a little bit more support beneath that at 3020 and then 3000. So this area should hold up quite well. And I'll show you here on another chart why there's some more support right here, doing something super special that I've never done for you guys yet. And so I'm going to show you that here on the next chart. But before I get away from this, we've now broken this 50-day moving average, which was the blue line. Again, we had been 19 weeks above the 50, which is a really long run, the second longest run in over a dozen years based on my research. So, there's a lot of things that have gone against this now. And keep in mind that all of this now becomes overhead resistance there, that once we start, whenever it is, once we start to go back up, there's going to be people that either put new money in the markets here or were new buyers, right? They just got in late to this rally, and they're just going to want to get their money back out at break even. It's just a psychological thing. It's the way it works. It's the way the markets work. It's the way they've always worked. So this area now, anything above 3120 or so, will provide overhead resistance as we try to climb our way back up and make new highs at some point in the future. But in the near term, it sure does look like these markets want to go a little bit lower, but it's pretty hard to tell from here. Now, on this chart, what we are looking at, and this is really cool stuff, guys. This is taking technical analysis to the next level. This is a 2-year S&P 500 chart, so each candlestick is still 1 day. But what I've done here is I've annotated this with what's called Fibonacci retracements. And the two key numbers to remember, there's kind of three, but the two really key numbers to remember on Fibonacci retracements, and it's amazing how well this stuff works, is 38.2% and 61.8%. Okay, if you add those two numbers together, you're going to get 100. And what I did is I went back to the beginning of this latest rally, if you will, that started at the end of December of 18. And what you do is you overlay this Fibonacci, these lines up here, and the software automatically draws this 38.2% retracement and the 61.8. Now, 50% retracement is a fairly common technical retracement of a prior move. It's not a true Fibonacci number, but what we can see here is this 38.2% retracement of this prior move that we had from the end of December of 18 would take us down to, and guys, it's not always exact, right? I mean, it gets us close, but it should take us down to 29.9110, right? Would be the exact number from where we peaked versus where we started. But the point is this, here's your 200-day moving average, which is setting at 30.4457. You've got, as we saw in the previous chart, there's some support here, this 30.20, 30.25 level. You've got the 3,000 number, which, as any of you know that have been watching my work, that is a psychological support level. So we've got a lot of things, and you can see some, some clear trading right in here, right? So there's a lot of support at this 3,000 level, plus or minus, 20, 30 points. But we've got the first level of Fibonacci retracements kicking in here as well at 38.2% of the prior move. So, a 50% retracement would take us down to the 2868 level, as you see there. And if we did get, and hopefully we won't, but if we did get a 61.8% retracement of the prior move, right, this move here, that 61.8% retracement would take us down to this 2750 area, 2744.98 to be exact, but 2750 is close enough. And as you can see, that's, again, there's a lot of support here. And we even pulled back and kind of tested this area clear back in June of 2019. So from a technical standpoint, I don't think it'll get much worse than right in here for right now. But guys, there's no way to know. I mean, we could literally, if things really start to change globally and the coronavirus continues to spread and we continue to have fears that companies around the globe will miss their earnings, then we will continue to see downside pressure. And we, it's not unthinkable that we could go clear back down to this 2350 level on the S&P. It's way too early to call that, but that would be a 100% retracement of this prior move that we had from the end of 2018, beginning of 2019. Okay, so I wanted to share this with you. It's a little geekier than what I normally do for you guys, but this is taking it to the next level. And then the other thing I wanted to point out here is, and this is just today's close. Let me just refresh this to make sure I've got the latest data. But guys, these are the sectors, the sector ETFs for the S&P 500. There's 11 sectors in the S&P 500. And these are the sector ETFs. And this is just today's trading. But what we can see here is that every single sector was negative. And as I change this, you can see the best performing sector just today was consumer staples. It was only down 1.8%, right? But you've got energy, materials, and the industrials were all down over 4%. And when we go back for the week, we can see here that everything has been down. Technology has actually been the hardest hit at 9.16% to the negative for the week. Energy right behind that, down 8.81, and then down 7.9% is communication services. Companies like Facebook are in there. And real estate has been the best performer, only down 3.61%. I have another video that I put together for you guys a few days ago talking about interest rate sensitive sectors and how they've performed over the last couple of years while interest rates have been falling. And it centers on these three sectors here: real estate, consumer staples, and utilities, which are the three most interest rate sensitive sectors in the S&P 500. If you have not seen that video, I would highly suggest you go out and watch that video. If you would like to learn how simple market signals can help you become a more successful investor, trader, or financial advisor, you will want to watch the video introducing simple market signals, which is on my YouTube channel. I will also leave a link to that video in the description box below this video. Thank you for watching. Don't forget to subscribe, and please give me a thumbs up on this video, leave a comment, and I look forward to seeing you in the next video.